All right, welcome back to another Noda Wealth Management quarterly market review. This time we are reviewing Q1 of 2026. Now, there's no surprise that there was a lot that went on in Q1, geopolitical conflicts, among many other things. But the stock market and the bond market generally did not as bad as I think people thought it would. So we're going to dive into that here today. I'm going to be looking at my screen. So if it looks like I'm looking down, it's just because I'm looking at my screen. And I'm also going to use my laser pointer here on the screen so you can all follow along. Okay, this is just an agenda of everything that we're going to go through. This is the same agenda that we use every single time. Stocks first, REITs, which are real estate investments through a stock-like product, stock-like vehicle, bonds, and then we'll wrap up. So starting off with how markets did in Q1 of 2026, the US stock market returned about negative 4%, which is not great, but relatively speaking, not that bad. I mean, think about what happened the first 3 months of the year, geopolitical conflicts, war, among many other things. And the market was only down 4%. And that's if you were holding the index that's being represented here. And you can actually look, okay, what was the worst quarter for the US stock market going as far back as we have reliable data? It was 2008 Q4, negative 22.8%. So negative 3.96% or negative 4% is only a fraction of the worst quarter that we've seen. So I think that's a strong point in saying, hey, you have to tune out the noise. You can't let the fear of the media impact the way that you invest and impact the way that you think about your investments. And international and emerging market stocks actually did much better. They were pretty much flat on the quarter. And then REITs were positive during Q1. So real estate investment trusts, it's almost like investing in a stock, but instead of a company ownership, you're investing in real estate. It was actually up 77 basis points or 77% of 1%, which was great for the first quarter given everything that happened. And the bond market was relatively flat. Okay. Long-term market summary. Before we go into more details on what happened in the quarter, we must take a step back and say, okay, what has the market done over the last year, 5 years, 10 years, and so on and so forth? Now, I'm not going to dive into every single box here, but if there's one thing you take away from this is that all the arrows are pointing up and they are green. That means that the market has gone up over every single time period that you see on the left-hand side and on the x-axis on the top of the chart, every single market. Now, that's not to say that that's always going to happen, but the point being is the more time that you're invested in the market, the more likely these arrows are going to up, right? Investors are rewarded over the long run. So how did the world stock market perform during Q1 of 2026? Well, we're looking at the MSCI All Country World Index. Think of this as an index that holds every single public company out there, not technically every single public company out there, but it's a good barometer of how the world stock market performed during Q1. You'll see that the MSCI index started around 475 and then finished just slightly below it. Now, we know that the stock market did go down during the quarter, but that is a slight decrease. And if you take the time to look at all of these headlines, so we've got tensions over Greenland and January, and we've got the S&P 500 crosses 7,000 for the first time, and then it moves on to the US and the Israeli war with Iran. And then more lately in March, just gas prices being out of control relative to where they were last year. That's a lot of things to deal with, a lot of topics to deal with, but the market really didn't decrease that much. And then if you look at it over the last year, so this was just Q1 of 2026, this is now Q2 of last year, all the way to the end of Q1 of this year, which is the last year, the market still went up. And I think this number right here does a great job. Yes, stocks went down 4% in Q1 of this year, but even with that, over the previous 1 year, they're still up 18%. So again, you have to take a step back, look at your portfolio and your investments at a higher level and realize the market's done pretty well. Okay, we're still on stocks, except now we're focusing solely on US stocks. And within US stocks, we like to break down that negative 4% that happened this year. Was it all stocks in the US market that were down 4% or 3.96? No. And the way that we do that is we look at them from asset class returns. Now, asset classes, just think of them as different styles, right? Apple and NVIDIA are large cap growth stocks. They're huge companies. that are growth in nature, meaning people are willing to pay more money relative to their fundamental value because they think they're going to continue to grow. And that tends to be these large tech companies right now. And then small and value stocks, think of these as smaller companies, still very big companies. These are not mom and pop shops. These are still very big companies, but they're not Apple and Nvidia. You're probably less familiar with them. And people are paying less for a share of their stock relative to fundamentals. So that would be the value that's associated with a small cap value stock. Small cap value during Q1 actually returned positive 5%. So I told you that the US stocks returned -4, but within that, there was this really good section of the market that returned 5%. Well, the good news is, as a diversified investor, you hold that small cap value section. Large cap value also was positive, and small cap was as a whole. So small cap value plus small cap growth was about positive 0.89%. So all that to say is there were good returning stocks in the US during Q1. It was just the large cap and large growth section that really dominated the total market return. International developed stocks, again, think of this as Germany, UK, Australia, very developed countries, but not the US. Same story. Value stocks, small cap stocks had positive returns. Actually, small cap stocks in US currency, slight negative, but still, it was a positive return for the quarter. And then the large cap and growth section was what pulled that return down. Now, if you remember, international developed performed better than US, because look how significant this US large cap growth negative return is, -9.78, compared to -4.60 here. So there were similarities between large techie companies not doing well across the world, but it affected international companies or the international stock market to a lesser degree. And then lastly, this pretty much a similar story with emerging markets. Think China. Value outperformed growth. So stocks that are cheaper relative to their peers, relative to their fundamentals, outperform stocks that are growthier relative to their fundamentals. That again tends to be those tech companies. And then how did countries do during the quarter? And this is one of my favorite slides because it shows every international developed country and emerging market country and ranks them based off of their specific country's return. So in Q1, the US was in the bottom third over here, just around -4%, like we talked about earlier. And Norway was actually the best performing stock market. Maybe that's because they had the most golds in the Olympic Games. Probably not, but about 26% is pretty remarkable for Norway in Q1. If you were to hold every country at its weight that it represents in the global stock market, though, you returned about -3% or so. Because remember, Norway did really well, but their stock market's tiny compared to the US. Worst performing countries, Denmark, India, Indonesia. Hit on Denmark again, about -13%. At the end of 2024, Denmark was the best performing country over the previous 25 years, going back to the start of the 2000s. So January 1st, 2000, the December 31st, 2024, Denmark was the best performing country. Last year, it was the worst. And then in Q1 of this year, it's keeping up with last year's poor return. So again, I think that just goes to highlight, you see something that performs really well, that doesn't mean you go jump into it. Even if it's been doing it for 20 years, you might be getting in just at the worst time. Okay, REITs or real estate investment trusts. So US real estate investment trusts outperformed non-US real estate investment trusts for the quarter, meaning if you were only invested in US real estate, you did well. If you were invested in global real estate, you did poor. And you'll see here 4.64 compared to -7.88. With that being said, if you use a global fund, you probably did much better than this -7.88. In fact, you were positive on the quarter because 70% of a global REIT portfolio is US. So 4.64 is not pushing your REIT investment in positive territory as much as -7.88 would if they were equal weighted. But the US REITs are weighted at 70%. And the international are weighted at 30%. And therefore, if you invested in global REITs, you were positive during the quarter. Commodities. This is the best section because commodities are just interesting, or at least somewhat interesting. The biggest ones that you heard about over Q1, silver, gold, copper. So we can see right here, gold returned 7.14%, silver returned 6.25%. So that's better than the stock market. But if you remember, they both had meteoric rises in Q1 and then like days later had meteoric downfalls, still landing in positive territory. But it just goes to show you that you can't hop on that ship when it's already sailed. It hit the market headlines. Everyone saw it. Everyone jumped in and likely rode some of that wave down. On top of that, not to get into taxes too deep, but commodities are very tax inefficient to invest in. So your after tax return is trumped pretty significantly from what you see here. These are just before tax returns. And then copper was another one. Copper was negative 1.3%. Coffee did terrible in Q1, negative 12.44%. Luckily, nobody that I work with invests directly in coffee. It just doesn't really have any economic rationale to why you should expect it to perform well. What performed the best? Low sulfur gas oil, heating oil, crude oil, and Brent crude oil. Interesting. Again, don't invest in commodities directly, very tax inefficient. And if you look at them as a diversified portfolio, yeah, they've done really well over the last 1, 3, and 5 years. Those returns are primarily driven by the last year and this quarter. But if you go back 15 and 20 years, man, that's pretty much flat. That's a lot of volatility to take for not a lot of return. Okay, bonds. I'm going to skip the next slide and just hit on this slide right here. This gets very complicated very quickly. The only thing that folks that I work with really care about are interest rates, right? Mortgages. We want to buy a house. We want to upgrade our house. We can't carry over our mortgage rate that we got in 2020. So now we need to get one that's in the sixes. Everybody was talking about rates coming down. The Fed saying that rates are coming down. Why not just wait to buy that house? Why not just wait to refinance that loan? Well, just because the Fed says that doesn't mean it's actually going to happen. And what actually happened was the shock with the war going on in the Middle East caused rates to increase. So what you'll see here, let me see if I can zoom in a little bit. I can, is that at the end of this year, the green, 12/31/2025, the short-term interest rates were below 4%. And then you look at the end of Q1 2026, you'll see between the 3-month all the way to the 10-year, you can't, this graph doesn't really show it well, but they jumped back up. And short-term interest rates jumped up slightly, very slightly, but more short intermediate, more like the 10-year and the 5-year jumped up somewhat significantly. And that caused mortgage rates to increase. If you don't know, mortgage rates, although they're 30 years, are based off of the 10-year yield, not the 30-year mortgage rate. So if the 10-year goes up, expect your mortgage rate to go up if you're trying to buy, and vice versa if it goes down. So long story short is, if you want to buy a home, mortgage rates are a huge consideration, but you shouldn't put off or delay that goal just because interest rates are potentially going to go down or potentially going to go up. And then lastly, I want to hit on geopolitical risk. I'm sure a lot of you have seen some of the emails that I've sent, the blog posts, the LinkedIn posts, but remember, up and to the right. The stock market over long periods of times goes up and to the right. And in order to experience up and into the right, you need to remain in your seat. You need to be invested through thick and thin. So when we wake up one morning finding out that we're in the middle of a war in the Middle East, your first thought should be something else, not let me go and check my investments. We've done this before. We've been through this before. Many wars, depressions, recessions, global pandemics, up and to the right. And this may have been mirrored on my screen, so maybe this will be up and to the right when you watch this. But the point is not to let the market headlines put fear in you. And with that being said, that is a wrap on this Q1 market review. Again, it is always concerning when there's geopolitical conflicts, but the market didn't do that poorly in Q1, and hopefully it does well in Q2. Thank you.